What's going on, everyone? This is Alex with Boss Crypto, and I am going to be your guide to technical analysis this month. Okay, so we're going to get started off with the basics of charting just to make sure everyone's on the same page here and knows how to read candlesticks. Okay, so candlesticks are representations of the trading range for a given time period. So you're always going to want to know which time period you're looking at, and you can see that by the top left of the chart. Right? So I am on the weekly right now, and that means each candle represents 7 full days of trading, right? And it has 4 major components to it. The low, which is the lowest price that was traded during that period. The high, which is the highest price that was traded during that period. The open, which was the first price that was traded at the open of that period. And the close, which was the last price that was traded at the end of that period, okay? And that's important because that is going to define whether we have a bullish or bearish candle, okay? A bullish one means the price closed above where it opened, okay? And a bearish one is a candle where price closed below where it opened by the end of the trading period, right? And you can see here, we have all different kinds of candles, some with larger bodies and larger wicks is what they're called. And a wick basically means that during this time period, the asset was traded at this level, but by the end of it, it came up and closed at this level, at the bottom of the candle. That makes sense? So you have the high, which also happens to be the open of this candle, right? There's not always going to be a wick, right? If price starts at this price level and then drops and never comes back up by the end of that 7 days, for the weekly, then you won't have a wick at the top. But price did travel all the way down to this level, but by the end of that 7 days, it was at this level where it closed. Does that make sense? And we can get these exact values by looking up next to the name of our asset here. We have the open, the high, the low, and the close of any candle that you're hovering over with your cursor, right? And we can see here, the open was very close to the high of this one, the open being 16,200 and the high being 16,300. Okay. All right, and it's always important to know your time frame because if we look, let's think about this, right? This was the open, this was the high, this was the low, and this was the close. And if you ask someone, well, how do you think price acted during this 7 days? They're going to say, well, or most of them will say, well, price started here and came up to the high and then went all the way down to the low before coming and closing here. And sure, it's possible something like that did happen, but it's equally possible for price to have started here, tanked to the low, ripped all the way to the high, and then come back down to the low by the end. It's also possible that price did this multiple times by the end of the candle. We don't know unless we were to look deeper at a lower time frame, okay? So we'd have to look at, if we want to know what happened in the 7 days, on each of those 7 days, we'd have to go to the daily chart to see this weekly candle broken up into 7 candles, right? Just an important little lesson there that we can get a lot from price action, but sometimes it involves going into lower time frames to really see what's going on. But more often than not, the highest time frame will give the strongest signals. They may be a little lagging, which is why we might use lower time frames for better entries, but the strong information comes from the higher time frames, right? So always know your time frame, okay? That's going to be all for the basics of candlesticks. I will catch you guys in the next video, which is the basics of a trend. Cheers.